Hey, it's Patrick Moore with Ironclad Wealth Management here, and today I've got a video that's a part of our Ultimate Guide to Saving Taxes on Selling Your Business series, and it's a strategy called the Charitable Remainder Trust. This is a great strategy because, like most good strategies, it's something that helps you do multiple things at once. So, what this does is it helps you reduce taxes to support a cause that you care about. But it's something that you and your family can benefit from along the way. So let's dig in and see if it's something that may work for you. Now, as always, this is general information, not specific tax advice. If you look at this, you have any questions, you definitely need to think about, okay, does this work for me? I need to talk to my own tax advisors to get an idea of if I should pursue this. So having said that, what is a charitable remainder trust? What it is it's a split benefit trust, meaning that there is an income beneficiary and there is a remainder beneficiary. So if you look at this guide, what happens is that you gift the shares of your business to a trust that has a charitable beneficiary. That trust then sells your business, and then you receive an income payment for the rest of your life. That's interest number one. You're getting that income for the rest of your life so you can replace the income from your business. And then when you pass away, your charity that you name at the front end receives whatever is left in that account. And that's interest number two, the remainder beneficiary. And because this is a charitable trust, that trust doesn't pay taxes on the sale of your business. Now, there's two types of charitable remainder trusts. The first is a CRUT, which is a charitable remainder unitrust. The easiest way to think of this is it's the percentage one. And then there's a CRAT, which is the charitable remainder annuity trust, which is the flat dollar amount, because you have to specify how much money you're going to take out each year from this trust. And there are rules about how much you can take. Now, if you do the percentage version, the CRUT, what happens is if your trust goes up in value, you get more money. If it goes down in value, you get less money. The CRAT is the opposite. You keep the same amount no matter what that trust does. Although if somehow you make a mistake and that trust runs out of benefit, then you would run out of money that you could take out of the trust. And your charity wouldn't receive a benefit when you pass away. Now, the key thing to think about here is your charitable deduction, because you do get a charitable deduction for putting money into a charitable remainder trust, is lower the more money you take out, because obviously it's weighted. If you're receiving more money, there's less tax benefits. But if you're receiving less money, the tax benefits get higher. Very straightforward. Everything has a trade off, and you're kind of balancing those two acts. Now, why would you use a charitable remainder trust? I've kind of mentioned a few of these things. But the first is that you get a tax deduction when you put money or business shares into the trust. You could fund this with stock, you could fund it with cash, but in this example, we're talking about saving money on the sale of a business. The best way to do that is to put the business in the trust before you sell the business. Now, if you do that and you sell the business within the trust, there's no tax on that sale, it's deferred. Now, you receive annual income payments. It could be 5%, 6%. Most people do 5% for the rest of their life. And then, like I said, your charity gets money when you pass away. So, what does this do from a tax perspective? Well, it defers, it doesn't eliminate tax, which means that while the money's in the trust, there's no taxes. However, when you start to take money out of the trust, you do recognize income based on what went into that trust. And it's what's called the worst in, first out rule, colloquially. It's called a tiered ordering system. If you inside the trust earn interest, have ordinary income, that comes out to you first. After that, it's capital gains and then other types of income as well. But essentially, what you need to know is you get a big upfront tax deduction for putting something into the trust that's going to go to the charity when you pass away. The business doesn't pay taxes when you sell, and then you will have to pay some taxes as you live the rest of your life. Now, that upfront tax deduction is nothing to sniff at, but like I said, it kind of depends on interest rates at the time. It depends on how much income you're taking out the rest of your life. But those are the main tax considerations of a charitable remainder trust. Now, what do you need to know as far as timing goes? Well, the charitable remainder trust must be set up well before the sale. If you do it too close, the IRS is going to still assign that sale to you. They're going to look at you and say, hey, The only reason you did this was to avoid taxes, and that's not legitimate to us, so you're going to have to pay those taxes anyway. So there needs to be time between the setup and the transfer and the actual sale. If you've already got a signed LOI, you don't have a chance. The earlier is better, but there's no rule I can say, hey, you need to be 6 months and a day, and then this counts. It depends on individual circumstances. If you can do it in a separate tax year, that really, really helps your case. But you do need time between those two actions. Now, the other thing is that there is an impact on your heirs. The assets left over go to charity. And for a lot of business owners, their business is most of what they've got. So if you look at that and think about it, you may be disinheriting your heirs if you set this up, if you don't have other assets. So if that's the case, there are a couple of things you can do. Sometimes what people will do is they'll pair a charitable remainder trust with a life insurance policy. So you can kind of take that annual payment, put a portion of it into the life insurance policy, and then gift that on to the kids. That's definitely doable. So the math on that typically works. And then the second thing is you can actually have the charity, and now this affects the tax deduction, so you got to keep that in mind. But the charity that you name can be a donor advised fund or a private family foundation, which is interesting because you still get a charitable deduction, but it lets your kids, when you're gone, have a say in what they would like to see happen with that money rather than just going to a single charity. And something to note too is it's an irrevocable election you make. So that charity, what if their values change? What if something happens that affects you and your opinions on them? Well, using a DAF, a donor advised fund, or a private foundation just retains more flexibility for you as the grantor and kind of control over who you'd like to see benefit from those funds. So there's some pretty cool stuff that goes into that. Now, what I've got is we've got the same family we've been working with throughout this series. It's the Daniels family. They own an engineering firm owned by a husband and wife. They're going to sell it for $10 million. They got basis of $500,000, which means they're going to pay taxes on $9.5 million of gains. If we look at this with their plan, with this comparison we have here, if they don't do anything, they will pay about $2.3 million in taxes. And if you take 5% of that, which is kind of the equivalent of what a CRUT would be able to deliver, they'd get $382,000 a year in income at a 5% income rate. So basically, they'd get $7.6 million out of this sale. Now, if they were to look at a charitable remainder trust, if they did that, this is actually a calculator, and the numbers that I have here are based on a calculator you can find in the accompanying blog, which has the current FR rates, which will fluctuate with the IRS publications. But they would get a charitable deduction with a 5% payment of about $3.4 million, which in today's tax rates at 42.29%, which is the top Georgia rate, 37% plus 5.29%, you would get a valuation on that deduction of $1.4 million. Now, they wouldn't pay any taxable gain taxes, and they would get 5% of the full $10 million, so they'd have $500,000 a year coming to them versus $382,000. And then they would have a deduction value and net proceeds, if you include the charitable deduction, of about $11.45 million. So that if you think about it, that deduction really wouldn't be able to offset too much. It's got a 5-year carry forward from like the sale. It offsets some those first 5 years. But a big benefit of that would be if in the year of sale you've got a lot of other income, that deduction can shield a lot of that, so you're not paying a bunch of income taxes at the highest marginal tax bracket. So really what this boils down to is, would you rather earn 5% on $10 million or 5% on $7.65 million? Well, you're going to pay a little bit of taxes on the 500 like we discussed earlier, but you're probably going to wind up in a better scenario if you spread that income out over the rest of your life and take that tax deduction along the way. So it's actually a really, really nice outcome in this scenario. When you just look at the numbers, it becomes really intriguing. Now, as with anything, what are the drawbacks? Well, when you're getting a charitable deduction and you're setting up a trust and getting benefits from it, this is an irrevocable decision. You're getting a tax deduction. The charity has to receive what's there, through the rest when you pass away. You have to take only that amount of income each year. There are some setup and administration costs because it is a trust. You can't directly gift S Corp stock, so you'd have to reorganize if you're an S Corp or do it a different way. The timing can complicate things if you're too far into your sale, and some of the payments and income payments you receive, depending on the structure of your gift, can be taxable. However, while one of these is a drawback, there's also a little bit of a benefit associated with it. The irrevocable nature and the trust nature of this structure, it can actually protect you from some creditors, some liability associated with that. So there are some benefits associated with these trade-offs, but when I look at this, I would say these are the things that I look at and say, okay, what makes a CRUT not worth it? Now, having said that, who's it best for? Well, I think it's best for people who already have a charity they love supporting, because at the end of the day, you got to have some charitable intent to set up one of these. You don't need a lump sum because remember, you can't take all $10 million out. You're only going to get 5% a year for the rest of your life. Now, it's going to go up as the account goes up, but it's something to keep in mind. People who are looking for asset protection, I think that's a big one because it can be beneficial. And the people who want that long term income stream as opposed to that lump sum. So, if that sounds like you, this could be a pretty neat way to, like I said earlier, solve multiple goals with one tool. And that's really where the magic happens. So, how do you set up a CRUD? Well, first, you need to review all the strategies available to you and model the tax impact. If the CRUT looks like it's the right one for you, you need to engage an estate and a tax attorney to basically get everything set up and get all the I's dotted and T's crossed. Then you need to decide what type of CRT you'd like to set up. You got to pick your charity, and then you got to have a trustee and administrator to basically have this thing run moving forward. And then the big thing, if you are going to use this to try and reduce taxes on the sale of a business, you'll want to fund this thing well in advance of a sale. So that's what you need to do to get this done. So what do? Well, we review the strategies from your perspective. We're not, CRUD administrators or anything like that. We're working for you. We then coordinate with those administrators, those attorneys, if you decide to pursue this. We help you run the tax models, explore pairing with insurance, help you invest the assets if you need that assistance. And then we ensure that the strategy aligns with your goals. Because if it doesn't, you can get in a lot of trouble just chasing things to try and save money on taxes. So you got to make sure it works. So remember, you got to start looking at things like this early. So go ahead and start exploring your options. If you want to schedule a consultation, no cost, no obligation, 15 minutes with me, go ahead and click that link there. If not, we got a lot of other strategies we're going over as part of this blog series. So feel free to click through to another chapter. And I hope that this really helps you as you consider what you're going to do to save money on taxes for your business. Have a good day.